sector enjoys historic high level of profit. And the labor market is becoming tighter and tighter. Unemployment rate being around 3%, which is basically full employment situation. However, the headline inflation rate has been around zero, largely because of substantially declined oil prices. But if you look at the inflation rate excluding fresh food and energy items, then this underlying inflation rate has been positive for 26 consecutive months and has recently reached positive 1.2%. So the economy has been making a moderate recovery, and we will expect this kind of growth will continue for some time, and inflation rate, even headline inflation rate, which is currently around zero, could improve substantially once oil prices start to bottom out. Of course, the Bank of Japan is fully committed to achieving the price stability target of 2%, and we will do whatever it takes to achieve that target as at the earliest stage. And we do not think there's any limitation for our policy tools to do so. As you indicated, the balance sheet of the Bank of Japan has significantly increased, but as I said, I don't think there's any technical or otherwise limitation to further strengthen our quantitative and qualitative monetary easing, if necessary, to achieve that 2% inflation target.
But you're not saying that right at the moment that you feel it's necessary?
We have been carefully watching the market development as well as the real economic development in Japan and also in Asia. As I said in my at the outset, the financial market turmoil this month has been somewhat more than anticipated, and so we have been and we will continue to carefully monitor those market developments and also continue to assess the potential impact of those market development on the real economy, including growth rate and unemployment rate as well as inflation rate.
Now, one of the issues in the monetary sphere, which I think Christine Lagarde mentioned, I'm pretty sure, is monetary policy divergence. So we've got a situation, you're easing, the ECB seems pretty clearly is easing. Mark Carney's recent speech suggests the Bank of England is neutral and the Fed is tightening. And into this mix is a very uncertain situation. We have, even the Chinese officials admit, very badly communicated about Chinese monetary policy and Chinese exchange rates. This seems to be part of what markets are worrying about. Does this combination of events worry you, or is it just a perfectly reasonable consequence of divergent situations among major economies?
Quick answer is, I think the divergence of monetary policies among major economies, I think is just reflecting divergent economic and financial situations in those economies. As you mentioned, Federal Reserve has already started normalization of monetary conditions, while the ECB and the Bank of Japan are likely to maintain extremely accommodative monetary stance for some time to come. These, I think, are quite natural and reasonable. By the way, this asynchronized kind of monetary policy among major economies could mitigate the
I take our well, let's call it neighbor, Mexico. Okay, they are a producer. These will reduce some of their revenues, but because they are also doing structural reforms, well, it may hurt a little bit, but you move forward, and that's the important thing.
Yeah, Larry, I disagree with you, although I understand it's very risky to disagree with the moderator on when you say the market disappointing about emerging market.
You can disagree all the time.
Emerging market growth is on downside in the past few years. We observe 92%. Almost all the emerging market growth rates has been down continuously in the past few years.
That was my point.
May continue to a little bit of lower in the next few years, but that's because cyclical reason. Because they have a different business cycle, they are in the maturing cycle, they have a very high, strong growth in the 2009, 10, and they are gradually coming down. Some countries have missed investments, some countries have an overheated credit bubble, they have to adjust. So I think that they are gradually slow down, adjust themselves. This is the process. But in the past 20 years, emerging market really built a very strong fundamentals, and that's built a base for them to move forward. Now the key issue is there's a big structure change within the emerging market and between emerging market and advanced economy. Globally, it's very interesting. Between 1990 to 2010, in 20 years, advanced economy consumption into the share of GDP increased from 75 to 80%. Now, it's Econ 101. When you have a C increase 5%, what do? Your investment drop 5%, right? You have to have a number add up. That's okay. The really thing happened in the emerging market. Where advanced economy consumption increased 5 percentage points, emerging market reduced their consumption 6 percentage points, increased their investment 7 percentage points. We're living in such interconnected world. Everything have to mirror to each other. Now, that's the point. The point is we start to see the advanced economy consumption gradually slow down, a little bit of investments they have to pick up, and the emerging market is readjust themselves, reduce the investments, increase the consumption. There will be big global readjustments.
Right.
I'm not sure what level they will be able to go back, but I'm pretty much sure most of them will go back. I think that's a very important global reshifting, restructuring. I think the policymakers have to pay attention on those issues. The second point, before I finish, to give you another 30 seconds, is the emerging market is a very big chunk of a global economy now. They account for 50% more global GDP, 60% of global investments, contribute more than 60 and 70% global growth. Now, but they still have a very low per capita GDP. They only, in average, have 22% of US per capita GDP. That means long way to catch up. That means a great growth potential. I would say after 100 years, when we come back to this podium to have this meeting again, I'm sure we'll be able to live to 150. Carlos is here, maybe you're older than us, but I'm sure you will be there. I think that we probably will not remember this financial crisis because this is just one financial crisis we experienced in the past few hundred years, but people will remember this is the year emerging market take half of the global GDP.
So I was just going to say, Kuroda-san, it sounds like you're right. Everybody's bullish. Mm-hmm. Everybody's bullish.
No, just a comment. Like I mentioned, emerging markets really broad denomination. So among of our countries, there are some that have, let's say, the investment to GDP ratio above 30%, and others have below 20%. So some of the things that are absolutely necessary for some, perhaps reducing investment. You may even have the contrary in others. I sometimes joke that, for instance, comparing with China, we have done some of this yin and yang, and you have now to turn it around. So it's important for Brazil to increase investment, and I see that China and maybe others are in the direction of really getting the fruits of growth and development more to the consumer, and that's also healthy.
Yeah.
Mark?
Extremely, very important point, the last point there about the transition that's going on in China, lest we forget the scale of the readjustment there, and I'll make a broader point. There's a series of transitions that are underway, and some of them may come to a point this year. So I think it's valuable to sit back within an overall posture of being cautiously optimistic about the outlook is the way I would put myself. 3.5%. If the IMF's right about global growth, that's a good outcome. These transitions in emerging markets towards more domestic demand. I mean, Brazil's there, but China. This is hugely important. Secondly, the potential transition of some advanced economy monetary policy in the greater divergence in advanced economy monetary policy will bring, likely, if it happens, likely a benign, in other words, a benign increase in volatility, and will test capital flows across the global economy, including to emerging markets as well, and will test the new financial system and the resilience of that new financial system. So we should be conscious of that because it starts with a positive, but has a potential feedback, and we have to be aware of that. On top of that, I think the energy market adjustment, we've all observed the dividend from oil. It's realistic to expect, it doesn't mean it will happen, that oil is lower for longer, given where cash costs actually are in across the globe, and given where demand is likely to be. So that creates an opportunity that is considerable and perhaps undervalued in terms of the outlook for the global economy. And lastly, if I can bring it back towards Europe for a second, there's a transition from everything being about monetary policy to everything being about structural policy, and I would include in structural policy completing the project of a sustainable monetary union, just parenthetically. In the UK, transition from household-driven growth towards more investment-driven growth as well in the context of a rising global economy.
Kuroda-san.
2 points. One, on China. I really think that the Chinese economy is making huge structural change. People may be more interested in gradual slowdown of economic growth, but still China is growing by 7.5%, and even if slightly slowing down this year, next year, but still around 7% growth. That is very respectable rate of growth. But more important is Chinese economic structure is changing. It is not anymore export dependent economy. It's more domestic demand oriented economy. And not just investment, but also consumption is increasing. And even in China, consumption basket consists of not only goods, but large part of services. And services do not need so much input of materials or those kind of things. So that Chinese economy gradually slowing down, but China's import of materials, commodities, as well as intermediate goods, is declining quite significantly. That makes the supply chain matrix in China, centering China, I think it's changing. This is a big structural change. It is good for China, it is good for Asia, and supposedly good for the world.
I need to move the discussion because we've been doing this for 50 minutes. I don't know if I heard the word U.S. yet. A minor colony.
We'll let it back.
What's that, Mark?
We'll have it back.
Yeah.
If it wants to come.
So from all of your perspective,
Just,
when you think about your monetary policy,
yeah.
your actions in Brazil, the ECB's monetary policy, and the Bank of England, and from the IMF, what are your predictions of the U.S.? I mean, you had to make these decisions based on that fundamental, I believe.
I missed the second point. Second point, just I say that the Japanese economy is likely to grow around 2% in fiscal 2015. It's not calendar year. So IMF WO is based on calendar year, which is a bit too pessimistic, but the difference is not so bad, not so big. But anyway, in fiscal 2015, we expect the Japanese economy will grow around 2%. Now, the US economy, I am extremely optimistic because the growth is so robust, not only in consumption, but also investment and also export. So I think the US economy is currently, of course, leading the global economic growth. And the economic growth in US is much more broadly based than before. So I have full confidence in the US economic growth.
Well, I don't have a prediction for the US. It's difficult enough to predict for oneself, so I'm not doing that. But for sure, the US economy will be strong. For sure, it will be stronger than the Eurozone economy. Our priority in that environment is that we want to be sure that the financial environment will remain fit in Europe, to the European economy, in the US, to the US economy. And for that disconnect to happen, we need well-functioning international capital markets, which brings me back to Mark's remark that the system is untested to some extent. We had a wave of new financial regulation, which by and large has focused mostly on banks. So we're pretty sure that now banks are much safer as financial institutions. We're less sure that financial markets, capital markets are safer. So that will be the priority of the regulatory community. We want to be sure that international capital markets work. And for that, we'll need an adequate degree of coordination. So we need to fight the temptation of ring-fencing financial protectionism, and that temptation is very often at home. It's in our heads.
Okay. Yeah, I would agree with these observations. As Mark mentioned, we may see some dislocations as a consequence of the current trends. The U.S. growing, it's good. It's good for Brazil. It's good, I'm sure, for several countries because of the demand it creates and so on and so forth. But especially a country open like Brazil to capital flows, we will be very watchful. And I think coordination will be very important. We are also strengthening our own situation, and when we strengthen fiscal and so on and so forth, it gives us an additional layer of protection if there is any dislocation in capital markets. But it's something that you have to watch very carefully and coordinate if something happens, and not the least because of the lower level of liquidity in so many markets, bond markets, and so on.
Mark? Let me I'll reinforce what my colleagues just said on that point. I'll make two others. First, as I think many are aware, there's a big difference between the path of monetary policy implied by the Fed through the famous dot plots and that implied in the market. And that gap will close somewhat this year, and the question is in what direction will it close and what impact that will have on volatility. That reinforces the importance of investors and, more importantly, people in the real economy, businesses, households, understanding the objectives of a central bank and how we'll react to certain circumstances. And I think the clarity of the Fed's mandate, the clarity of the ECB's, and very much the clarity of the Bank of England's mandate, if I just say one word on the UK, which is that we have a very low inflation environment right now. largely caused by commodity prices. We have an ability to look through that, and we have a responsibility. We have the means and the will and the responsibility, and we will do it. We will return inflation back to target within the 2-year horizon so people can rely on that. Now, the second point I wanted to make on the U.S.
Have confidence, absolutely. So what is it that they're scared of? Is it that they don't believe the policy framework that the Bank of England has laid out to achieve its targets, and now we see this little wobble on forward guidance? Or are they concerned about the longevity of your own government and the fact that you may not be around to follow through on some of the fiscal policy that you've implemented?
Well, I have a very strong interest in the survival of my government. No, look, I think, first of all, on forward guidance, you keep saying, things like the wobble, and to quote you. I think that's being unfair.
Well, we thought it was a very important policy tool,
I don't think
and now we learn it's just one of many, and we don't need to worry so much about the threshold.
I think you're being unfair to the Bank of England. They set a threshold of unemployment, and thanks to the success of policy, both Bank of England policy and government policy, unemployment's falling very quickly, and so people are talking about what comes next. As I say, that's a kind of challenge of success rather than a problem or a failure, if you like. Second, I think business investment, there is evidence, and we have an independent forecaster in the United Kingdom that is forecasting an increase in business investment. I think you are beginning to see investment. You're certainly in the UK seeing huge inward investment. Countries like China and Chinese businesses are choosing the UK as the go-to destination in the West for investment. I think that's because they do see political stability, a credible monetary and macroprudential framework, a credible fiscal policy, absolutely central, and an effort to undertake supply-side reform. So, for example, we're a country saying, yes, let's build nuclear power stations. Plenty of other governments in the world don't want to take on that challenge. We're prepared to. We're saying yes to fracking in the United Kingdom because we've seen what it's done in the US and indeed in other places. There are plenty of other Western governments that don't want to touch fracking because it's too hot to handle. I think we're prepared to take the difficult decisions that will allow the investment to flow.
Larry Summers, I just wonder for a moment if you want to come back on that and talk about where that, because the point you've been making all the way through here is actually the money isn't going where it needs to go.
Look, I think the Chancellor and I are in complete agreement on the importance of stimulating private investment and creating a more enabling environment for private investment, and that's got many structural aspects. I suspect everybody on this panel would agree. I think the Chancellor and I are, I'm glad to see, very much in agreement on the importance of public investment. I think in the American context, I think that the right investment strategies are actually win-win-win, that by growing the economy, they grow the tax base, which collects more revenue and substantially pays for themselves. And look, we're going to fix Kennedy Airport someday.
Yeah.
And so making that investment today removes a future fiscal burden. So I see much less need to impose cutbacks on people who are very vulnerable right now in the American context than the Chancellor sees in the British context. And of course, I would recognize.
But you've not been a fan of UK austerity, and that's on the record.
It is a fair comment that I have. That is an entirely fair comment. I think the difference would be that the Chancellor highlights the similarities and the risks associated with the other countries in Europe, and I would see Europe's difficulties in those increases in bond yields as centrally related to the fixed exchange rate, the absence of a central bank, and the uncertainties that would be created if, for example, a U.S. state were to pursue a massive fiscal expansion. And so my way of thinking about this would be quite different. I've been very gratified to see the growth in Britain in the last months. On the other hand, if you compare, for example, the United States and Britain, it was a long time ago that we exceeded, a couple of years ago, that we exceeded our previous peak GDP. That's something that is still being sought in Britain. And so I think it does need to be recognized.
We did have a much deeper fall in GDP, and for a banking sector that is the same size as the US is, but in an economy a fifth or a sixth the size, the impact of the financial crisis was even greater in the United Kingdom than it was in the States. So, we have come. We had, the Great Recession in the UK had an even greater effect, and we were one of the worst affected of any of the major Western economies.
Yeah, and that's part of the reason why the deeper the valley you're in, the more rapidly you are able to grow. But despite the best efforts of our moderator, George, we probably have a common interest in stressing our points of agreement, rather than our points of disagreement. And I think they are the importance of generating demand through increased investment.
So I want to move on.
They are
Larry.
also, just one thing,
Very
they are, I
quickly.
think, also what in the Japanese context is called, and I suspect Mr. Kuroda would agree here, the third arrow policies of
and that's where
structural reform.
And I want to bring this in because so far the message I have received is that central banks are like the fire brigade. They turn up, they put out the fire, and then gradually they pull away as they've damped down the flames, and then the construction team comes in, supported in part by the government, and rebuilds the house after the fire damage. Now, if that is correct, there's something I misunderstand about the Japanese experience, because the way that you tried to deal with your crisis many years ago was to send the builders in first, even knowing that the flames were still there, licking up the sides of the building. And that didn't seem to work. And of course, that phrase, roads to nowhere, bridges to nowhere, became very relevant. So is Japan's monetary policy tactic different? And if it's different, what does that do in terms of helping us shape our understanding of the future for monetary policy?
I understand our Prime Minister Abe delivered his speech arguing that so-called Abenomics has been successful. Abenomics consists of monetary easing, fiscal,
with
flexible
respect,
fiscal policy.
I don't want to just revisit this. I'd like to just focus on going forward.
Structural reforms. Now, the government has already started fiscal consolidation, and it made quite clear that the government aims at halving primary deficit by 2015 and completely eliminate primary deficit by 2020. And fiscal program is on track. Actually this year.
So let's just get the point of differentiation here. So you disagree with Larry Summers, actually, because the government can fiscally consolidate while the central bank stimulates. So you do not need the kind of construction or investment in education that Larry's talking about.
You have to see the Japanese government fiscal policy in greater detail. The Japanese fiscal policy consists of two parts. In the short run, the government provides stimulus through public investment and tax credit and so on and so forth. But at the same time, in the medium to long run, the government is determined to consolidate fiscal position, reducing and eventually eliminating the primary deficit by 2020. So the second arrow, so-called flexible fiscal policy, I think has been successful. I mean, initially providing fiscal stimulus and already starting fiscal consolidation process. looking at the economy is on track and
to borrow a
growing
phrase,
close to 3%.
to borrow a phrase from a famous economist,
Yeah.
in the long run we're all dead.
Yeah.
So if you're saying in the long run,
Yeah.
you know, that fiscal consolidation takes
Yeah.
place.
Yeah.
This is a bait and switch. The Japanese government needs the confidence of the markets to consistently drive down treasury prices here and maintain stability even as it stimulates. So my question really is, are you rock solid in your belief that the market will continue to buy the story you're selling? Or is it only the fact that you have such significant domestic holdings that you don't need to think about what foreign market participants do with JGBs?
Again, I mean, I don't really disagree with Larry Summers or Chancellor Osborne. I mean, in the short run, the government can provide fiscal stimulus. But in the medium to long run, they must consolidate fiscal position. And the Japanese fiscal position is in a serious situation. So that the government has already started fiscal consolidation. And this fiscal consolidation program must be, as you are alluding, must be credible. Otherwise, certainly, market could at any time reduce holding of JGBs, raising long-term interest rate in Japan, and so on and so forth. So the government has a credible fiscal consolidation program, and so far, the program is on track.
Excellent, thank you. I want to move on, and I want to talk a little bit about bubbles, because inevitably now we're talking about exits. A lot of this is to do with making sure that we keep a lid on bubbles, or we head them off or burst them before they become a serious problem again, knowing the experience that we've all come through. Governor Jordan, if I can just start with, or President Jordan, if I can start with you on this, because you have used other tools to try to rein in excessive property market speculation. And this has not been the big hammer of interest rates. This has been about bank capital buffers, and that's been a way of trying to micromanage the property market, where we do see now in some economies quite bubbly behaviour in terms of price rises. I think the UK was 8%. Was it the price rise across the UK? Much higher in London, of course. Parts of the US, high double digits. So how do we head off the bubbles before they start? Do we have to look to things like macro-prudential tools like this, given what we know about the weakness of the banking sector? We're encouraging the banks to lend. At the meantime, we're also using tools like this to rein in their activity.
Well, macroprudential tools become very important. Chancellor Osborne already alluded to that a minute ago. In Switzerland as well, we built up a concept, a strategy for macroprudential. Now, every country is a little bit different. And in our situation, we have very low rates. And for a couple of years, we have now a very strong housing market. We have also mortgage growth that is above average, above nominal GDP growth. And given the fact that monetary policy, the key interest rate tool, is not available, we have to use a complementary instrument, and these are the macroprudential tools. And now we used, not for the first time, we already used that a year ago, and now we increased the countercyclical capital buffer to 2%. The hope is that that will have two impacts. One is making the banking system stronger, and on the other hand, also have the incentive not to provide as much mortgage credit as in the past. So to make mortgages relatively more expensive vis-à-vis other credit. But every country is a little bit in a different situation. If you do not have a housing bubble and you have a credit crunch, then obviously the macroprudential tools are not necessary. So you have to really make a judgment on the overall situation, whether they make sense or not.
Chancellor Osborne, are we going to see some of these tools implemented in the UK in the near future, i.e. this year, given that you've already pulled back on some of the funding for lending programmes directed at the housing market? Is it time now, given where we are in house price inflation, to start dampening down the animal spirits?
Well, that is a call for our Financial Policy Committee in the Bank of England, and we've created, this is a brand new arrangement. And they have already started some of that process. So you just alluded to our funding for lending scheme, which was helped to bring bank spreads down, they have withdrawn that scheme for future mortgages. But they also did something else in December, which didn't get a huge amount of press, but they tightened up mortgage approval standards as well. So they've got a whole range of tools. And I think, inevitably, and I'm not complaining about this, it's just a fact of life. Everyone in the UK and here, they're focused on interest rate moves, and I can see that. But actually, there are a whole other range of tools that the Bank of England has now. And I think one of the lessons of the crisis has been you do need to bring all these things together, as we have done, into the central bank. We have bank regulation now in the central bank. We have macroprudential tools in the central bank. And, of course, we have monetary policy in the central bank. And ultimately, the attempt to separate those functions out fell down during the crisis. So that coordination exists. And I think, rather immodestly, I think the Bank of England